Wood names, which I find ironic and interesting in and of itself, that those are the kind of names that she continues to bet on while you're saying, I don't need this anymore. These are not the kinds of stocks, it would appear to me, that the market really wants or investors want to be in now.
Scott, you and I talked last October and December, and I said we were lightening our load, and we were lightening our load in those type of names. And our concern was simply that as the market pulled in on the risk curve, that those would be the first names that would be penalized within the growth sector. And of course they were. Those names are now down 70, 80, in some cases 90%. I'm not saying those names aren't investable today, but I don't think you have to go that far out on the risk curve to get really terrific returns for yourself and for your investors. And so it's really about your appetite for risk. But you're right. We consolidated. I told you this in March. We consolidated behind our best ideas because I don't know if the market is going to have an appetite to invest in 3 weeks, in 3 months, or whether this is going to take 18 months for us to work through this inflation and rate concern. And so during that period of time, if you want to ride that volatility, you have to know you're in a business that's going to be worth more in the future because of the fundamental things that are happening in that business. And so we consolidate into our most confident positions.
I don't want to put you in an uncomfortable position to have to pile on Cathie Wood, but when you see what's happened to that fund with some of the names that you used to be in and the way that you just articulated why you're not, I'm just curious as to what you make of all of that.
Listen, I don't know much about a research process, but I know it's effectively an index fund on stuff that I view as, part of the highest risk component of the growth sector. And, I'm not sure if and when the world's going to want to return to that level of speculation. Bill Gurley and I were talking last week, and he sent out this tweet that I totally agree with, which is you can't anchor yourself to prices that the most risky companies were trading at last year. The Fed, by taking rates to zero, forced everybody out on the risk curve. And so what you want to do is own quality companies that you know are going to compound top line, that you know are going to compound bottom line, and be worth more in the future. And I just don't think you have to take that type of speculative risk today. But, clearly she has a research process she believes in. I think I told you at some point last year, that we had shorted a basket of SPACs, that we were short, indexes like ARK, to hedge out some of the growth risk in our own portfolio. But that's just because it represented the riskiest part on the growth curve.
You mentioned, one of your best ideas. It remains one of your best ideas in your portfolio. One of your larger positions, obviously, is Meta. Stephanie Link, I want to bring you in here because you're adding to Meta. What do you have for Brad Gerstner? And we are just, a week off the quarter in which seem to relieve some of the investor concerns that have been around that name. But what do you got for Brad?
Yeah, hi, Brad. It's great to have you today. So the biggest question everybody has on Meta is, can they monetize Reels, and how long will it take them to monetize Reels, and can the stock work if they don't?
Well, Stephanie, I've heard you talk about it. I happen to agree with a lot of your position on the name. I mean, let's take a step back on Meta for a second. Generating $25 billion in free cash this year, bought back $9 billion worth of stock in the quarter, generated $8.5 billion of free cash in the quarter, in a quarter that they had almost everything that could go wrong, right? Whether it was IDFA, whether it's lapping some of the hardest internet comps because a year before everybody was sitting on their couch surfing Instagram. This Q1, everybody was out in the world post-COVID doing things. And so they had a lot of natural headwinds. But even in that tough quarter, they managed to generate over $8 billion in free cash. Now, on top of that, I think they articulated something that's extraordinarily important, which is Facebook, for the better part of the last decade, has been a friend or social discovery engine. They showed you content that your friends recommended. They've made massive investments over the last couple of years to turn themselves into an artificial intelligence discovery engine. That is the secret behind TikTok. We're investors in ByteDance, TikTok. We know a thing or two about why they have been so successful in targeting customers. As Mark said on the call, When you make that transition, you go from being able to recommend from 2,000 pieces of content to 2 billion pieces of content. So we think they're in the early phases of an engagement expansion game, and obviously Reels is going to be a key component of that. 25% of Instagram usage is already Reels. They aren't monetizing it that much, but there's no reason. In fact, we think they have the best monetization engine in the world, that they won't be able to monetize Reels as we go into the back half. We think that growth into the back half accelerates significantly. And you're doing it with a company, again, that has a disciplined approach to free cash and to buyback. So we feel like you have a protected downside and you have a lot of optionality to the upside.
Let me ask you one last question before we take another break and do our final segment after that. It plays right off of this conversation that we're having now, the whole FANG acronym, which some now suggest is dead, that you can't invest in the basket like you used to. Netflix has its obvious issues. You know, you just gave us your view on Meta, Facebook. Well, what's your view overall on that? Has FANG run its course? Is it dead?
Well, set aside FANG for a second. Just think about the hyperscalers, right? If we talk about Amazon, if we talk about Google, if you talk about Facebook, Microsoft, et cetera, I mean, they just gave you incredible prints in the quarter. I mean, the clouds themselves, now $40–50 billion in scale, that are growing at over 40%. Scott, just 3 years ago, people thought their growth rates would be in the mid to high teens, and they're growing over 40%. Our single biggest area of investing in both the public markets and the venture markets is in the shift of all enterprise workloads into the cloud. We saw a massive acceleration into the quarter. That's not going to abate anytime soon. We think that's a decade-long investable trend, highly profitable businesses. And so, you know, we saw a lot to like in the quarter, and you get to buy it at a much fairer price than you could last fall. And I think that at the end of the day is the most important takeaway, which is buy the stocks that you've been waiting to buy now, hold them for a year or two, and they'll exit higher. You know, a lot of people said to me, well, I'm just going to wait. You know, they felt like they missed the last year. I'm just going to wait until we had a correction. And I always said, once you have the correction will occur at a moment in time that will have a lot of uncertainty. And by definition, when the correction occurs, nobody wants to buy anything, and that's why you get these market resets.
But you're not put off at all. I mean, Amazon didn't exactly have an incredible quarter. I mean, but all revenue growth, you know, almost across the board, not for every one of them, for certain, was slowing. I mean, it was a standout from a number of these names that revenue growth is slowing from where it was. Now, maybe that's because you were in a pandemic and, you know, you're doing some top-line growth that you can't repeat to that degree, certainly sequentially. I don't know. You tell me what you think.
I mean, Scott, not to interrupt, but, you know, come on. 40% growth in a software company off a $50 billion base. These are extraordinary growth rates, which just a few years ago, nobody anticipated. And what it demonstrates is the secular power, the shift of all enterprise workloads to the cloud is way more powerful than the impact of inflation, slowing growth, increasing rates. What you want to do to protect yourself from inflation is find growth assets with durable secular trends and great margins, and those businesses all have them.
All right, another quick break back. Our final segment with Brad Gerstner is just after this break.